All right, guys, we have minutes from the Fed's September FOMC meeting, and there's a lot of fantastic news in there about tapering, but also the real killer to the potential bull market, interest rate hikes coming. We don't really have a date yet, but I want to talk to you about all of that in this video because hopefully I want to ease your mind a little bit, but also give you some potential things to think about when you're investing in the stock market. So all of that in this video, so stick around. Hey guys, welcome back to the TipRanks YouTube channel. I'm Richard Allen. Thank you so much for joining me for another video. In this video, we're going to talk about the Fed because they just released minutes from their September FOMC meeting. Now, hopefully you know what the Fed is, but if you don't, the Fed is responsible for monetary policy here in the US, so it's a big deal when they meet. The FOMC, or the Federal Open Market Committee, meets 8 times per year, and they meet to debate interest rates and vote on policies. Now, currently, the Fed is spending $120 billion per month on both treasuries, so U.S.-backed securities, but also mortgage-backed securities as well. The Fed is currently buying at least $80 billion in treasuries and $40 billion in mortgage-backed securities. So they're talking about tapering that. But when? There's been debate on when this is going to happen. Is it going to happen in 2022? Is it going to happen in 2021? But when they met last time, they said, look, you can probably expect some tapering this year. So we talked about that, waiting until September for us to kind of get some news on what's going on. And we finally have those minutes. It looks like they're going to be tapering in November or December, but it's not the end of the world. So I want to give you a little bit of reassurance here. The real worry is interest rate hikes, and we're going to talk about that and kind of the psychology around how that's going to happen and whether or not they're going to have to raise interest rates sooner rather than later. But let's talk about tapering first. They're looking to taper in November or December and stop tapering around the summer of 2022. So that's really important to keep in mind. The minutes indicated the central bank probably would start by cutting $10 billion a month in treasuries and $5 billion a month in mortgage-backed securities. Again, the Fed is currently buying at least $80 billion in treasuries and $40 billion in mortgage-backed securities. Okay? So keep that in mind when you think about tapering. Not the end of the world that they're backing away $10 billion a month and $5 billion a month for mortgage-backed securities and treasuries, respectively. So just keep that in mind. It looks like that tapering will end this summer, next summer at some point, okay? Now, the real kicker here is interest rate hikes. They talked about interest rate hikes as well. They voted unanimously right now to keep interest rates at between 0 and 0.25%. That's really good news in the short term. Okay, but inflation. Now, the Fed wants to keep inflation around a certain amount. So I want to read a little snippet from the minutes for you right now that gives you a little indication in terms of what we can expect going forward. Okay, it says all members agreed to keep the target range for the federal funds rate at 0 to 0.25%. And they expected that it would be appropriate to maintain this target range until labor market conditions had reached levels consistent with the committee's assessment of maximum employment, and inflation had risen to 2% and is on track to moderately exceed 2% for some time. Now, the thing I want you to take a peek at that end there is 2%, 2% inflation, and be on track to moderately exceed 2% for some time. Now, moderately is not doubling that number, and that's where the concern comes in. With all the supply constraint issues, what are we averaging right now year over year for this inflation this year? Over 5%. Now, that's relatively troubling. Inflation has ran pretty high all year. We have skyrocketing energy costs, skyrocketing, auto cost. Home prices are through the roof. Food is starting to be affected a great deal. And there's many reasons for that, but it has to do with supply constraints. Now, If this continues into next year, and it certainly could, and I'm going to tell you why, we could see interest rates get hiked way sooner than 2023, which is what they're expecting. Now, here's why. Right now, there's a huge issue with supply, and pretty much across the board. Now, there was just an oil spill just last week in LA, so we have ships stranded outside of California right now. We also have ships taking between 9 days and 15 days on average to be able to port in places like Georgia. So it's both coasts that are running through these supply constraint issues because of what? Labor shortages. There aren't people to, one, unload these massive cargo ships. There aren't truckers to get these cargo containers to where they need to be, right? So not only are we having shortages of different materials like chips and things like that, but we're also finding that it's hard to get these materials. Once we have them, it's hard to get them to their end destination. That it could really, really blow up into a big, big issue next year, which could cause inflation rates to continue to go up. But here's where I want to give you a little bit of hope. Now, inflation rates ran really, really hot this year and are still running really, really hot here in 2021. However, in 2022, we're going to be going up against this year's numbers, right? So the monetary policy that they're making in 2022 in regards to interest rates hikes, right? We're going to be going up inflation numbers from 2021. That's good news, right? Because then if inflation doesn't run 5%, it doesn't run, 6, 7, 8% above where we were last year, right? Then we're in a situation where they aren't probably going to raise rates as fast as people are saying, because we're going to be going up against this year's numbers next year, right? So inflation numbers should be lower next year unless we see this issue with supply constraints just become more and more exacerbated with labor shortages. But at some point, they're going to have to start raising wages or something to get people to want to do these jobs and get people trained to do these jobs that, people just aren't interested in right now. There are people leaving the labor market every single day. You continue to see things called the Great Resignation, people just leaving and not returning to the labor market. And there's various reasons for that, political and not. I'm not going to get into that right now, but there's a lot of constraints on the economy right now, and the Fed is doing its best to kind of keep everything under control. I don't think that they're going to raise rates until 2023. That doesn't mean we're not going to see a big crash next year at some point. It does mean that they're doing everything they can to ensure that that doesn't happen. So I don't think the tapering issue is that big of an issue in the short term, but interest rate hikes, if we see supply constraints worsen, I think we're going to see interest rate hikes sooner rather than later, and that could be bad for the bull market. So one misstep by the Fed, one raise of an interest rate when we're not expecting it, will send the market into a tailspin. It always does. It seems to, right? And I would encourage you to treat those moments as opportunities because the market always recovers. And is there a chance it won't? Sure. But you are better off trying to not time the market, but have time in the market. And I hope that makes sense. So you invest $100 today and you just leave it alone. There's a really good chance it's going to grow if you invested in an index fund over time. And I really, really appreciate you guys sitting here and listening to this. I appreciate each and every single one of you. If you have any questions for me, let me know down in the comments. If you have any sort of other ideas around this and when the Fed might hike rates, I would love to hear your opinion. Your opinion is always appreciated. Thank you so much for watching this video. As always, if you found any value or learned anything new, let us know by hitting that subscribe button and that like button down below. And as always, I'll see you in the next video.